Myers. Thank you for joining us for this webinar update with James McDonald and Jeremy Bender, the portfolio managers of the Pengana High Conviction Equities Fund. Today, James and Jeremy will provide a brief overview of their investment philosophy, and they will explain the areas that they focus on and the characteristics that they look for in the companies that they invest in. And then they will sort of describe how they put it all together into a portfolio. They will also go into some of the portfolio positions that have driven performance and that they continue to have confidence in going forward. So James, over to you.
Adam, for the introduction, and good morning, everyone. Today, I'd like to begin by giving you a short overview of the portfolio and process, which I think I've spoken to you about in the past, but just to refresh your memory, and then really take a deep dive into 5 holdings, which we obviously think all of our holdings are fantastic, but these are particularly interesting at the moment. Lots of volatility in the market with inflation, Ukraine, rising commodity prices. So we just really wanted to reinforce to you that we are very excited about the stocks in our portfolio, and we do believe they can drive performance over the next year. For those of you who don't know, Jeremy and I are co-portfolio managers on the High Conviction Fund, and you can see our experience there, which I won't go into. It's a portfolio of 20 stocks, can invest in both small and mid caps in Australia. It's primarily more focused on small and mid caps, not exclusively, both Australia and overseas, with a maximum of 20% invested in Australia. I would highlight that our Australian exposure are really international based or international businesses with just happen to be listed in Australia. We'll talk about some of those today, but there is that limit there. It's a mix of both value and growth. Environmental, social and governance factors are very integral to the process, and we have a negative ethical screen. We do have high exposure to healthcare and IT in particular, being about 45% of the portfolio. Performance over the last 12 months has been disappointing, down 15% and underperforming the market. There's been a number of reasons for that. A big one is we can't invest in oil and gas, which has done, and fossil fuels, which has done phenomenally well after the Russian invasion of Ukraine. We've been overweight Australian dollars and Japanese yen, which hasn't been helpful. And there's been a number of stocks that have been hit by rising bond yields and concerns over a slowing consumer. I'd highlight, Rakuten, Japan's largest online retailer, Magnite, a US advertising technology company, as a couple of names there. We do have quite a high exposure. We've got a relatively good exposure. We've got about 13% in cash at the moment. On portfolio positioning, we reduced holdings in some of the COVID beneficiary stocks earlier in the year, so things like Merck KGaA, Bio-Rad, Novavax, and just in very recent times, we've been reducing some exposures to some of the opening up trades that have done very well for us, things like Hollywood Bowl in the UK. Jeremy's going to touch on a bit of those in a minute, but they've performed very well, and we are a bit concerned over consumer exposure. At the same time, we've really been increasing the weight in some of the names that have been aggressively sold down as bond yields rise. Our view on interest rates is that there's been quite a lot priced into the market. At this stage, the long-term 10-year government bond yields around 3% in the US, and the market is pricing in something like 2.5% to 3% interest rate increases in the US over the next 12 months. So, some pretty aggressive moves in interest rates have really, in our view, been priced in, and we are just trying to take advantage of those stocks that have really been punished in that process. I'll touch a bit more on that later on. For those of you who don't know, Our portfolio is the characteristics we're looking for in the portfolio are companies with strong competitive positions. So that might be a technology, something like in healthcare, patent positions, or a platform technology. It could be a brand, a consumer brand like F45 gyms or a theme park. It could be a low cost of production. What's much more important to us is making sure we're buying those businesses at a significant discount to their fair value. And we think that gives you good downside protection and hopefully gives you good long-term returns. We prefer companies that are under-researched, out of favour, or have hidden value. It's not always the case. But if you find those characteristics, we find that stocks tend to perform very well if you get it right. We love companies that are generating good free cash flow. If they don't have good cash flow, then they need to have strong cash balances that can get them through to cash flow break even. It's interesting now that there's about 330 biotech companies trading below their cash at bank, it's potentially an area that could be interesting to find those companies that are deeply discounted compared to their cash. Quality of management is extremely important. We love companies that are owner-led or have strong shareholdings in the company and stock options packages, so that we know they're really aligned with our interests as shareholders. So when we create a portfolio, the first thing we do, as I mentioned, is work out what the upside is. We calculate the intrinsic value, and I've got another slide on that in a minute. We look for catalysts to re-rate the shares. We look at the business model. Very importantly, at this point, we are also looking at environmental, social, and governance factors. And quality and experience of management is very important. The second thing we do is look at the risk of the company. The biggest factor there by far is the cyclicality of the business and how much debt it has, how predictable are the earnings, and also factors like the liquidity, how easy is it for us to buy and sell the shares. We're primarily investing in developed markets, so geopolitical risk isn't so important, although recently there's things like the Japanese yen being weakening very quickly, which has got benefits for the exporters, but as I mentioned before, has cost us in some of the defensive names. Finally, those two factors give us an implied weighting in the portfolio for the stock. Simply, a company with high upside and low risk can be a very large position in the portfolio, 10 or 15%. Low upside, high risk really shouldn't be in the portfolio. And that's the matrix there that I just referenced. Can't have more than 15% in one stock. And we have sector and country limits, which I won't read out, but on the left-hand side. Just in terms of valuing stocks, what do we think about? We're really thinking about how much free cash flow does a company generate compared to its enterprise value, which is the market value plus any debt, sort of the price if we'd have to acquire the whole company. And a company with very low growth, and also we look at the riskiness of the business. So a very low growth company, low risk like a telco, we think it needs to be generating 7.6% or better return to make that attractive. If we're very confident that a company is going to be growing 15 or 20% a year, then the free cash flow yield we're prepared to accept will be much lower. Because, if you look out in 4 or 5 years, obviously that free cash flow number will be much higher. They're the sort of businesses that have been really punished at the moment, the high growth ones, as the 10-year bond yield has risen, and they've made them look relatively less attractive. Valuing a biotech company, we've only got one of these in the portfolio, which I will speak about, but you really need to do a risk-adjusted net present value. And the way the industry really looks at biotech stocks is depending on whether they've got phase 1 data, phase 2 data, or phase 3 data, you put a different risk weighting on that net present value. And that's really because there's a very low probability of a phase 1 drug making it through to filing. So that's why we would apply a 13% risk weighting if you've passed phase 1. If you've passed, phase 2 or phase 3, you put a much higher risk weighting on that product. Just on the ethical and ESG side, I would say we've been doing this for 20 years. It's very much part of our core process and second nature to us. But as I mentioned before, we do integrate environmental, social and governance factors. We engage with company management when we meet with them on these issues. We vote with all of our shares at the AGM and we disclose our voting policy. And finally, we exclude anything that's harmful to the environment or society, which you can see in red. I won't read them out, but by far the most significant is fossil fuels. I would guess we exclude about 15% from the market. So now just taking a deep dive into some of our holdings. One of the areas that's been really weak over the last 12 months is the biotech sector. The S&P Biotech ETF, which is the ticker is the XBI in Australian dollars, is down 41% this year. You can see it in the purple line at the bottom. And that has impacted our holding in IMMUTEP in particular. In red, it's down 25%. Telix has fared much better, up 12%. But actually, I should just point out while we've got that chart up, Telix in the white did have a big correction from January. It got up to about $8.50. We entered the stock about 3.5 years ago below $2. And as the stock ran up, it was a 4 times return. We did greatly reduce the holding in Telix, probably cutting the holding in half. And then as it's fallen in recent months, we've had the great pleasure of being able to buy most of those shares back at around $4 a share. And we see substantial upside. I just put in the chart there, Telix is compared to Lantheus, which is up 180% over the last 12 months. And we really feel that there's a good chance that Telix is going to follow suit over the next 12 months. They have a very similar product competing in prostate cancer diagnosis. And Lantheus got to the market 6 months, got approval 6 months or 7 months ahead of Telix. And Telix feels quite confident they're able to match what Lantheus has done. And I'll speak a bit more about that in a minute. For those of you who don't know, I've actually been following the radiation oncology industry for a lot of my career, probably about 18 years. There was a predecessor company in Australia called Certex Medical. Actually, quite a few of the management team members are in Telix. But this is really, I think there's a real revolution going on in radiotherapy in recent years. It's becoming much more targeted to treat the cancer. I mean, the first generation was really external beam radiation, where you point a huge machine at someone lying in a chamber, very insensitive and can hit a lot of soft tissue. Then we had radioactive beads that were injected into the bloodstream. These are actually radioisotopes that are targeted to molecules or antibodies that selectively seek out cancer in the body. You inject it into the body. At low doses, if you do a PET scan, you can see where the cancer has spread throughout the body on the top right there. And you can use that for diagnosing how to treat that particular cancer. If you increase the dose substantially, you can actually use it as a therapeutic to treat the cancer. And it actually works very well with both chemotherapy and immunotherapy. And I think this modality of treatment is going to be around for a long time. There's been a lot of small radiation therapy companies. It's been a bit of a cottage industry. And Telix is doing a great job of consolidating that and creating a platform company. They've now got 11 products. So it's really not a one-trick pony by any means. The first product coming is already approved in December. Expect a second and third to follow soon after in 23 and 24. So it's got a market cap of about $1.3 billion US dollars and $155 million of cash. Just got there. The consensus revenue target for this financial year is about $75 million. And next financial year is about $195 million. We think that the company can beat this very substantially, and I would just highlight, if they're able to do what the competitor Lantheus has done with its product called Plarify, that would imply Telix this year could do 190 million in revenue, and next year could do 550 to 600 million dollars in revenue. Interestingly, Lantheus reported results on Friday night, was up 12% on a night when the market was down 4%, which was very impressive. It's about a $1.1 billion US dollar market for prostate cancer diagnosis in the US. Lantheus is implying they're going to have about 35% of it this year. Still plenty of room for Telix to take an equivalent amount of the market over the next 12 to 18 months. We would think that when the company reports in July and then again in October, really watch whether they've been able to ramp up as quickly as Lantheus. That would be $10 million roughly Australian dollars in July, $50 million in September, and then about $150 million when they report, $130 million when they report there in January, if they can match Lantheus. They do have another product, a kidney cancer diagnostic, which we'll get phase 3 results from in August or September. It has fast track approval from the FDA. It's a $300 million market opportunity with no competition. And we expect that yet to be approved probably late 23, a brain cancer diagnostic in 24 with another $200 to $300 million TAM. I should just jump back and say, if they're able to achieve that 550 or 600 million in revenue next year, we think they'll be pretty well placed to earn about 130 or 150 million dollars in net profit. So you'd be talking about a company that's trading on 8 or 10 times PE in 2023. And I would just highlight, CSL and ResMed trade on 30 times PE, Cochlear trades on 50 times PE. And I think that will just come to the attention of the market. I mentioned that they have one final product which I really should mention because it will be absolutely transformative for them. It's a prostate cancer therapeutic product to treat prostate cancer, just starting a major global phase 3, which will take a couple of years, but a $5 billion potential market. If that's successful, this won't be a $1.3 billion company. It'll be a 10 or a $20 billion company. And then they also have a renal cancer therapeutic product and a brain cancer therapeutic product, which are a bit further out. But it's the therapeutic products are where the real upside is in this stock long term. Diagnostic products are very nice. They're cheap to develop, faster to develop, but not the same potential. Why do we think that Telix can match Lantheus in terms of their market share? Just would like to make a point that Telix uses something called a gallium generator, which is a shoebox-sized device, costs about $100,000, and they're already widely distributed across the US for the production of a cancer drug from Novartis. And Cardinal Healthcare, the largest health distributor in the US, is their major distributor. So they cover about 60% of the nuclear medicine pharmacies in the US already, with a pharmacy, with a sales force when combined with Cardinal's that's actually larger than Lantheus's. Lantheus is produced in a room-sized thing called a cyclotron, and they're in universities and very large hospitals. So the red dots is where Lantheus is present, blue dots is where Telix is present. Interesting to note that in Florida, there's no red dots. That's 25% of the prostate cancer market alone. So will be all in Telix's court. Telix won't get full approval until the full reimbursement until the 1st of July. So we expect a modest quarter this quarter, and then a very good quarter in the July quarter. So that's Telix. Second healthcare stock that I'd like to talk about is IMMUTEP. Market cap of 280 million, halved from its highs about 6 months ago, $87 million of cash. Its lead drug, called eftilagimod, or EFTI for short, is targeting about a $50 billion opportunity in cancer immunotherapy, breast, lung, and head and neck cancer. Last week, they were just awarded a very prestigious oral presentation at the American Society of Cancer Oncologists, which will be held on the 3rd of June in the US. It's the largest healthcare conference in the world. The abstract will be released on the 26th of May. I think we can only assume it's very good news. There's only 8 or 9 oral presentations in lung cancer, and it's also just interim data from IMMUTEP'S, so even more unusual that they've been awarded a oral presentation. So we're greatly looking forward to that. They've commenced a new study in head and neck cancer, which I'll discuss soon, and they'll get results, some early interim results, hopefully this year. And I just highlighted here that similar biotech deals, either licensing or takeover, would probably be in the US $2 to $5 billion range. So very substantial upside, and I would really hope over the next 12 to 18 months that this company is licensed or taken over. I just mentioned the $50 billion market opportunity. Metastatic breast cancer in immunotherapy is a $30 billion market opportunity. Head and neck about $2 billion, and lung cancer is about a $23 billion market opportunity. Just very briefly, looking at the results of why the market and we are excited about it. This was the initial data from lung cancer, reported about 18 months ago. In blue is Pembro or pembrolizumab. Also, the brand name is Keytruda, the largest immuno-oncology drug from Merck. And in green is the combination of Pembro and EFTI from IMMUTEP. And this is the overall response rate in first-line lung cancer patients. So you can see a very impressive doubling of the overall response rate from 20 to 40%. They expanded this study from 30 patients to 120 patients, and that's what's going to report in June. And if they're able to replicate these results, I think the market is going to be very excited about IMMUTEP and a licensing deal going forward. The second study is head and neck cancer, where similar thing, we saw a sort of a doubling of the overall response rate. On the back of this, the FDA gave IMMUTEP fast track approval in head and neck cancer, and they've started a new study with 150 patients in first line head and neck cancer. This one was in second line. This study will potentially allow the FDA to approve the drug if the results are good. So we might be able to see this drug come to market by potentially 2024 if they report results in middle of next year. So a very rapid route to market for them. So that's a small cap, but something that we are looking forward to over the next 12 months. Now I'm going to hand it over to Jeremy to speak about a couple of other stocks we're very excited about in the more in the consumer space.
As many of you may remember, we spoke last time about some exciting stocks in the US. One of those stocks was Dave & Buster's, which we have exited, having made a profit on Dave & Buster's. We did that because we saw their competitor, Main Event, having a relatively cheaper valuation compared to Dave & Buster's growth rates. And that business, Main Event, is owned by Ardent Leisure, which is actually listed in Australia, but it's a US-based business. Subsequent to exiting our position in Dave & Buster's, Dave & Buster's actually have entered into an agreement to buy Main Event off Ardent Leisure. And that leaves us with a very interesting company now in Australia, where Ardent Leisure is solely focused on Dreamworld and SkyPoint, which are two leisure destination products on the Gold Coast, theme parks, and an observation deck. Post the sale of Main Event, 90% of the current market cap of Ardent Leisure is in cash. Of that, 430 odd million will be returned to investors and 150 million will be retained in the business, giving them a very strong balance sheet. The current market capitalisation of Ardent Leisure implies only a $70 million valuation for Dreamworld and SkyPoint. Over the years, I've followed this stock for nearly 15 years, Ardent Leisure in its previous incarnations, and those businesses have the capability combined to generate between $30 and $40 million of EBITDA. Now, we don't think that that the business will be listed for a long time, as we think that trade buyers will be interested in buying these types of assets, and we've seen those assets transact for 8 to 10 times EBITDA. Dreamworld is in a turnaround. Why are we confident those numbers can be hit? Because they've invested 113 million in capex over 6 years versus under previous management, we think it was clearly neglected. There's been an improved guest experience, evidenced by higher net promoter scores and very good Google reviews. Better technology in the park, driven in part by COVID, but in part by management, has led to higher per cap spend, and there's rational pricing occurring on the Gold Coast between its main competitor VRL, Village Roadshow, which was acquired by private equity. The attendance, we think, will rebound to post-COVID, pre-COVID levels once the post these restrictions coming off, and we've seen that very strong rebound in other markets across the world. And I'll just note that Qantas yesterday released very strong domestic travel numbers, with domestic travel over Easter at 110% of pre-COVID levels. The resort has significant land holdings, which gives it flexibility to build an integrated styled resort to enhance the guest experience and enhance earnings. And there's some excess land as well. So just taking that all together, we do think that over the next 6 to 12 months, there's going to be strong evidence of that turnaround and potentially an M&A transaction, which could lead to quite a nice uplift, which I'll go through on a per share basis next. If we look at that per share basis, the stock's trading around $1.30 at the moment. 90 cents is covered by that cash distribution that I mentioned. 31 cents is to be retained in Ardent Leisure. And then if we look at where we think Dreamworld could trade in a low and a high case and put it on a mid case valuation, I think there's potentially another 70 cents there for Dreamworld. So on a 1 year view, we think that the stock could definitely generate us a pretty interesting upside around there of 40%. So moving on to our next stock, which we spoke about last time. It's been quite an up and down story. We invested in this stock post its IPO, not in the IPO, and around about the current share price. It re-rated back to the IPO share price of around $16, and then it subsequently derated. We think unduly so, given concerns over interest rates and the impact that may have on the US consumer. But we're not seeing that occurring at the moment. I'll just go through what F45 is. It is a franchise business for gyms. The revenue is mainly generated by recurring monthly franchise fees open per gym, and there's a margin on equipment sales to the gym. So it is not impacted to the extent that the gym owner would be impacted by a small change in attendance. So long as those gyms are profitable, they'll keep paying those monthly fees. And that's what attracts us, because it's a capital-light business with an enormous worldwide pipeline and opportunity of potentially 25,000 gyms versus the 2,000 gyms that it currently has. There's the chart there looking at its expected gym openings, and we've cross-checked that, as you can see from the next slide, which is publicly available information on their website. We're checking that pretty closely every week, which shows the actual number of gyms that have been opened versus market expectations. We can correlate that, and so they're hitting their numbers. They are opening in line with market expectations, and we think that the current share price is overly factoring in a weakening US consumer, but we don't think that will typically flow through into lower gym openings because the gyms will still be profitable. We've got another stock here, which Jim mentioned, taking advantage of the tech sell-off. That stock is blacked out because we think we could be buying some more. We started an initial position in it, but it just shows that we're able to buy a stock there which has got nearly 30% sales growth, and is trading on multiples that are very, very low, and it's in that lower quadrant. That for that sort of sales growth, typically you're paying many multiples more of EV to sales. And the next slide just illustrates that once more, that there's been a big derate in a lot of these growth stocks. This growth stock, we think, is, there's that saying that the market's throwing the baby out with the bathwater, and this is a stock that we think stands out with having channel checked a lot of its users and done a deep dive into it, that we're confident that it has a very strong medium-term growth strategy and is not likely to be impacted by declining or high interest rates impacting demand for the product, because in fact it massively enhances corporate productivity. So that's the end of the three stocks that I'd like to chat about, and I'll hand back now to James or Adam to ask if anyone has any further questions.
First question, and Jim, maybe switch on your camera as well, because I think that this is a question that's probably better for you. So great, thank you. So basically, this person said, I read your explanation of TLX in the recent fund update. Why do you think the rest of the market is missing this fantastic opportunity that you are seeing?
Yeah, it's a good question. I think the Australian market in particular is very focused on cash flow and earnings, and less biotech stocks are less popular in the Australian market generally. You know, I mentioned that sort of analysis where you're doing phase 1, phase 2, phase 3 doesn't really seem to be a mainstream kind of investing strategy in Australia. So I think TLX is going to make this very interesting transition over the next 12 months, where it does start to generate very significant revenue and profits. And then hopefully that is going to be a catalyst for re-rating. I do see some Australian institutions on the register, but by and large, I think it's not widely held in the market. Recent capital raising, I understand a lot of it was offshore as well. So hopefully we can get a better domestic following. It has gone into the ASX 200, so that obviously helps raise awareness. But and then, you know, there was a large capital raising in January, which probably didn't help right as the market was rolling over. But we really just need to, I think, see that revenue growth hopefully starting in July, Adam.
And your outlook for the rest of the healthcare sector, are there other areas that look interesting?
Yeah, look, there's been a lot of interesting ideas cropping up. The hospital sector in particular has been really highly impacted by rising inflation of nursing staff costs, and have been heavily sold off. And you know, we've just seen Ramsay Healthcare taken over in Australia for 12 times EBITDA. And now you can buy hospitals in the US on 7 times EBITDA. So that's an area we've been looking at. Biotech has fallen a long way. As I mentioned, there's 330 companies trading below cash backing now. I think there's about 30 above $300 million. So, you know, there's starting to be some interesting valuations thrown up. From a technical point of view, I think the last shoe to drop in the pure biotech space is that the biotech funds start getting heavy outflows, which hasn't happened yet. But certainly the valuations are starting to look more interesting.
Great, thank you. And from a thematic perspective, and Jeremy, maybe that's a better one for you, ardent leisure feels very different to the other examples that we've discussed in this presentation. What does ardent leisure add to the portfolio? Do we include for diversification, or sort of do we have a portfolio construction perspective when we look at it?
I think it's a very low risk trade because of that large amount of cash backing. So we're fundamentally sticking to our knitting in that we see a big discount to valuation. We also very cognizant of the fact that Australians haven't had the opportunity to travel to Queensland, and it is a very popular destination. And on top of that, we see the potential for foreign visitors as well coming back. So we just see that, despite its consumer facing exposure, we see such a disconnect between its valuation and the upside that it's quite compelling in what we see as a relatively de-risked turnaround story. And the M&A transactions that we've seen in the last 12 to 24 months show that longer term owners of these assets are really wanting to get hold of these types of businesses.
And I think this last question is really an excellent one. When you think of your current portfolio holdings and consider the current environment, war, supply chain shortages, inflation, rising rates, etc., what are you particularly worried about, and how well are you positioned for the range of potential outcomes?
Yeah, it's a great question. And I think most fundamentally, I think if you're buying companies that are a big discount to their intrinsic value, as I mentioned, I think that's really key to our process, and hopefully can weather more storms buying cheap stocks. I think we are well diversified. I mentioned before, we've been adding some sectors that have been heavily sold off. We have a reasonable amount of cash which we can use to take advantage of opportunities. But yeah, I mean, there are a lot of factors. Rising rates will obviously tends to favour, or at least rising bond yields tends to be better for value type stocks, and we do have a mix of both value and growth. And then we're trying to take advantage of some of these growth stocks that have been sold off, so that if inflation does peak and bond yields start to settle down, hopefully they're the sort of stocks that will recover.
Is there anything you'd like to add to that?
Yes, I think what was Jim's key point is that there are a lot of interesting stocks now available to invest in with this pullback. We are kicking the tires on stocks that have recently been listed that are 50% below their IPO price and have very strong cash backing. The portfolio has got the cash there to deploy, and we're seeing opportunities to also invest in stocks that do have somewhat of an inflation hedge in them. There is a large need for a lot of commodity stocks to fuel the energy transition. That's not new news, but there is ways of playing that where we don't have to take stock specific risk on a resource, and we can buy companies that provide services and goods to those types of companies on a global basis that we're seeing as potentially being in multi-year super cycle earnings upgrade style phases. So they are presenting themselves as attractive opportunities at the moment in this current pullback.
Great, thank you. So there are no more questions now. Thank you everybody for joining us for this update today. I'm always struck by how clearly James could explain the complexities of biotech and pharma investing in a way that makes sense to broadly makes sense to people who are not very involved in the sector. But for me, the real insight actually came from that last question, because although this is a high octane strategy. It has value components, it has growth components. The managers have clearly thought through the range of risks, and the portfolio is diversified enough to provide resilience in a really tough environment, while still providing the opportunities for outperformance that we've come to expect from them, quite frankly. Our next webinar in the series is next Tuesday at 4:30 p.m. That is with the managers of the Pengana Web Sustainable Impact Fund. You can register for that and the other webinars in the series on our website. If you have any other questions, please get in touch. We'd love to hear from you. Thanks very much.